Hi there everyone, good morning and welcome to The Market. I'm Avan Dabash, with me Nikunj as well as Anisha Jain. Well, let's kickstart the show then by telling you about how the US markets wrapped up, and it was a pretty decent close you had for Wall Street across the board. Yesterday we did see a slight dip at the close to the day's low is where we wrapped up the trading session around the 18,129 mark, but I think lackluster, flat, dull is just really the way to describe the direction of the market in yesterday's trading day. But pertinent to note that from the highs that we've recently hit, the index has corrected by close to 1%, so the consolidation continues. As a pocket, it's been real estate that's cracked for 3 straight days on the trot. Financials barring PSU banks have managed to aid the gains, and you had a strong show from the earnings candidates, SBI as well as ITC. And of course, Nikunj, the fact that FIIs continue to remain net buyers, 16 straight days on the trot.
Just one of those days where news flow is just so much that I'm puzzled to say that where do I start from? Honestly, in the morning when you're preparing, this is the sheet you've come up with. Oh my God, that's the level of news flow what you have. But the basic headline. The headline is, we've had a good week. Now, you may use we may use this week's price action and substitute it with just one word: consolidation. And I think there is nothing wrong with consolidation. We are consolidating after a monster rally, what we've seen in the month of April and early part of May. There's nothing wrong with it. Second, the global setup. Nasdaq has made a comeback, and Nasdaq has made a sizable comeback. Globally, the concerns around debt ceiling, they are getting diluted, and that is in a sense fueling some comeback in developed markets. Third, the liquidity, it continues, and now you can see that not just FI buying into large cap stocks or index heavy stocks, now the action in some of the rank mid cap stocks I think is evident. I was looking at some of the rank mid cap stocks yesterday: CRM, Silk Milk, Zomato, Aptech, just to name a few random names here. Now the HNI and the positional trader is happy to buy into mid and small cap stocks. So the confidence to buy, the FOMO effect, re-rating in some of the mid and small cap stocks, I think is done. And yet markets have not reached what I say as the Humpty Dumpty level. What is Humpty Dumpty in the market? When you see 2-digit stocks, they are flying. When you see extraordinary bulk up in terms of the open interest, you see an extraordinary print of extraordinary price action in mid and small cap stocks. You add all that up, I don't think the market is adding weight. Yeah. But right now the market is adding muscle. It is not adding fat. Markets will top out when they start adding fat and when they become Humpty Dumpty. So whatever we've seen, I think it is simple addition of muscle in the market, not fat. So till the time market will not add fat and become obese, I don't think this market will fall, and I don't think we are there yet.
Okay.
Read a book on health, that's why muscle fat.
I think right now we're slim and trim maybe.
So it doesn't have too much fat. It's a bit, there's not much euphoria at this point of time. Very, very, tempered move, and there's more upside on the market. But what could at least spoil the party for the AMC stocks today is the SEBI discussion paper, which is the latest edition. And a slew of changes have actually been proposed, right from including the brokerage and transaction costs into the TR ratio, to the capping of the TR ratio, as well as the fact that GST is now likely to be included as well. So a whole host of actually issues coming in, and brokerage Jefferies believes that this could impact the profitabilities of AMC by as much as 13%. Let's try and decode that. Nikunj, first your take as to what you make of this particular proposal. Yes, it will lead to more transparency, etc., but the profitability of the AMCs will come under pressure.
So first, what is SEBI trying to essentially, what is SEBI trying to do? The mutual fund industry has become big and large, and the operating scale has kicked in. If the operating scale has kicked in, the total cost of running a mutual fund and cost of servicing a unit holder has to come down. I think that is the spirit behind it, because the mutual fund industry was working on a commission structure, and that commission structure was in a sense applicable when the size of the industry was nearly 1/4. Progressively, the TR has come down. Now, what is TR? TR essentially is the revenue what AMCs make. According to Jefferies, and I'm quoting here, Jefferies feels that the proposed fee can impact AMC's profit by 13%, and there could be a little bit of pass-through. So which means for a unit holder, the cost comes down. AMCs will have to, they will have to adjust to the new normal. They will have to pass on some adjustment of TR cut, and distributors could also take a hit. That is what has happened previously when the TRs would be cut. Third, I think equity dominated mutual fund schemes will have a larger impact. For example, HDFC, AMC, they have a very large component to equity. Then it's SBI, but SBI is not listed, so it's a subsidiary of SBI, and the overall scheme of things wo pata bhi nahi chalega. So equity-based mutual fund schemes will have a very large impact. I think there's also a mention that if you are beating the benchmark, you would be allowed to perhaps charge more commission, TR in this case. That is something which I think is great news. Ultimately, mutual funds should be allowed to, the mandate of the mutual fund is, Bala is ready, can we go to him? Bala, good morning. I know you're traveling right now and you've really gone out of the way to accommodate this interview request. So where are you traveling, sir? Where are you traveling to?
I'm just on the way to Pune, Nikunj.
Thank you for joining us. We were discussing the impact of the new, SEBI proposals. How will that impact the industry, and how will that impact Birla AMC?
No, of course, this was a part of the discussion, Nikunj, if you see. Even SEBI chairperson, when they had the press meet after the last board meeting, they did mention about various initiatives that they're taking for the capital market in general, and in particular to our mutual fund. Then all these things that has come in the discussion paper, they are more or less in line with what was discussed in the MF Advisory Council, as well as the SEBI chairperson briefing to the press. I would assume that the process would be, I'm sure many people in the industry would benefit, the model will get how to undergo a change, and those representations would be received by the regulatory authorities, and post that again they'll go for a consultation, and not necessarily that every recommendation that is coming in would pass through, or would get accepted, or would get rejected. Therefore, one has to just see within this which are the one would actually be dropped. But the fact of the matter is, as you rightly mentioned in your opening remark, I think the scale benefit, the beneficial good investors, and basis which all these discussions are coming in. And from a AMC's point of view, I would assume, I think the AMC one industry in the last many number of years, I must mention that have faced a similar changes in the regulatory environment, right from entry load going away and so on and so forth. Therefore, every time such thing comes, the business model has to get adjusted. One, you remain a relevant large player and focus on both increasing the customer base and serving more number of customer base. At the same time, maintain the overall profitability. And that remains one of the core area of focus at every point of time. Too early for me to comment at this point of time, since we are also, we've also as an AMFI as a body has given the proposal to the SEBI in the past, and what can be done, what cannot be done. So those, I think, will go as part of the discussion paper, and then we have to wait for the final outcome to come.
There is a specific mention for debt mutual fund that the TR should be cut down. But do you think that is something which may not have a very large impact, because the TR in debt on an aggregate level is actually not 2%, it is already way below 2%?
Yeah, I think the fixed income schemes, if you look at liquid funds, generally is about 20 basis points, and then go up as the duration increases, as the credit risk that we take is increases. But otherwise, I think the funds which are at the higher bracket at this point of time size is low. At the same time, today was a great opportunity. This year, of course, a great opportunity to investors to look at fixed income schemes, given the yields are high. At this point of time, as it stands today, of course, impact will be less. At the same time, the real need to build the asset class such as credit funds, long duration funds, where we need a larger, they are like, you take more like an equity risk. The development of such product may actually get a little backseat. I think it's more than a real impact. We need to look at which are the areas where the development will happen for the future. But those, to some extent, it can have impact. But otherwise, as it stands today, the impact will be the least.
Bala, just wanted to get a sense from you because these are the initial thoughts coming in from Jefferies, but they are expecting that the caps can hurt AMC's profitability by as much as 13%. And one of the ways to kind of rationalize that is pass through as well. What's your own take whether the industry will pass it on to the investors or not?
Yeah, I think at this stage, it's difficult for me to comment in terms of what kind of impact would come. But at the same time, as I said in the past, whenever such thing happens, the business model also needs to get adjusted in order to ensure that the economic model of everybody remains intact. But that's something we'll have to just see on this.
Coming back to the first point that you made, that this is in line with what the earlier discussions has been. So, should we expect that this proposal will sail through in its current form, or you would be making some recommendations on this?
No, as it is, as the body, we had given certain recommendations in the past. And at the same time, the market participants, now it's a public discussion paper. So I'm sure all the market participants also give their input. My own assumption is there are certain things has to be sitting outside the TER and all these things. I'm sure as they receive many proposals from market participants, that will be subject to review. I would assume one could expect some dilution on some of the things that they have proposed, like tax-related issues and other things. That we'll have to just see.
Appreciate your time and enjoy your stay at Pune. So, Bala, will you be stopping at the Pune highway for the Vada Pav?
No, I'm already stopping on the side of the road and talking to you.
Thank you so very much, Bala. I really appreciate that you could take this call.
Yeah, thank you.
SBI, nothing wrong with the numbers. Now, why did the stock fall?
That's a curious case, right? Because same with ITC, right? We have brokerages upping the target price. Goldman Sachs has upgraded it, calling it another strong quarter. Morgan Stanley saying number is ahead of estimates. They've hiked the target price to 474 from 415. So a material upgrade coming in from Morgan Stanley. But nonetheless, both of these stocks corrected quite a bit after the numbers. You think it was a bit of profit booking perhaps?
See, ITC is
the
overbought.
Operating profit wasn't great. Was it just that number that maybe spooked the street? Because the rest was fine.
Yeah, I think SBI will bounce back. And I'll tell you why it will bounce back is because what happens in the short term is a function of F&O, technicals, the weekly expiry, positioning. There is a whisper number, there is a HOS number, there is an estimate number, and then there is an actual number. So there are too many numbers which keep on floating around. So depending on what the positioning is, what that day's compulsion on the Nifty or the bank Nifty is, the stock will move. I don't see anything wrong with the numbers. I mean, I've said that who says elephants cannot dance? Here's an elephant which has started dancing. That's State Bank of India for you. How do you look at bank? You look at bank in terms of, at this current juncture, nobody is bothered about NPAs because the NPAs are not there. We are beginning of a credit cycle, or when we are in a strong credit cycle. So they are talking about a growth which is still in double digit on that kind of a large base. B, expected credit loss, that's the ECL loss, and the dilution risk is going to be very low, which was a concern which came out after the Canara Bank numbers. I think State Bank of India, in a sense, has doused that. Net slippages could remain negative, but the 9 months leading to it were very low, which means there is no problem in terms of net slippage. ROA, which is where Mr. Khara, I think, has done an incredible job of turning things around. ROA for State Bank of India historically was always under 1. He's taken it above 1 and he's managed to keep it above 1. And he's giving, or in State Bank of India is talking about ROA staying above 1. So I think these numbers are strong, and these numbers in a sense can really have an impact on the stock. Now the stock also, just think about it. In last December versus now, that's about 6 months. My producer will file 6 months graph for State Bank of India. In last 6 months, State Bank of India as a stock has done nothing. It's down 4%. And the bank Nifty has gone the other way. Does it deserve to trade at 574 in this kind of a market? No. So what happens in the short term is a function of a lot of other factors. I think State Bank of India stock should bounce back. ITC is expensive, The cigarette volume growth, impressive. FMCG business, impressive. But the P multiple, ITC is not at 200. ITC is at 400. The stock is up 25% this year. It's up more than 100% in last how much time, sir? ITC 100% up in last 1.5
March it was 215 to 20. So
it's doubled since then.
It's doubled.
Almost in 12
Almost
months.
1 year and 2 months.
Yeah, so just imagine for a stock which nobody liked, it's up 100%.
Yeah.
So whatever happens to the numbers, it's, see, with companies like ITC, you're not riding a cycle. With a bank like, with a cyclical business like banks, you're actually riding a cycle.
Correct.
ITC had gone through a volume uptick. It got battered down because of this entire ESG stepmotherly treatment it got. So the P re-rating has changed. Cigarette volumes have stabilized. FMCG business is growing. But there is nothing in next 2 quarters which will give you a huge trigger that will continue to keep on re-rating the stock. And under-owned stock has become purely, ITC is now getting the spot and price it deserves. But State Bank of India will have a tailwind which is called cyclicality in credit growth and low NPAs, which will keep on taking it higher. So if I have to choose between SBI and ITC in the short term, I would say it will be SBI.
Okay, fair enough. But at least when it comes to ITC, it's interesting that brokerages across the board are upping their target price, 475, 470. Those are the kind of target prices from Morgan Stanley and Goldman Sachs, respectively. All right, earnings aside, let's focus in on all the global commentary, and tracking that is Vinny. She joins in with all those updates. Morning, Vinny.
Good morning, and firstly we'll start with the hot topic that is on the US debt ceiling limit. When is it going to be increased? Now we have a word coming in from McCarthy, who's saying that there is a progress coming in, but they still have a lot of work to do in terms of that. There is a scenario and a possibility now coming in closer that we could see a deal coming in together as well. Furthermore, McCarthy says that he sees the debt limit deal on the House floor as early as next week as well. So let's keep an eye out on that update coming in furthermore. Moving on, Federal Reserve's Governor Philip Jefferson said that, inflation, he's talking about the inflation side, which has continued to remain high. But on the other hand, he's also highlighting that, the rate hikes that have happened, that doesn't immediately start seeing that impact, and maybe that there's a lag effect in terms of the monetary policies effects coming into play as well. Outlook is not for recession is what they're highlighting, but the growth has slowed considerably, and that's a factor one should keep an eye out on. They expect more job growth, to also see a further decline. That means an increase in terms of unemployment rate that could see a rise there as well, and they remain uncertain in terms of the tighter credit, which will influence and how that will influence in terms of the households as well as business spendings. We have a word from Fed's Logan, who she's highlighting that doesn't see yet a case for a pause amid the high prices that we're seeing. The data is coming in weeks could actually show that there is an appropriate to skip a meeting, and as of today, they believe that though they aren't there yet, but yes, maybe a possibility of a pause amid this high prices is still something that one should watch out for, yet doesn't see that happening anytime soon. And let's talk about Walmart, that did report its numbers. There was a commentary coming in from the CEO on India as well. They said that they did visit India last week, and it seems like there's a lot of opportunity here. They see a lot of excitement in the growth coming in from the Indian market as well. And both Flipkart and PhonePe, they highlight, have continued to impress and meet their expectations as well. So positive commentary from Walmart, global CEO, at least on the India front.
So those are the global commentary coming in, but let's take a stock of what's happening across the globe as well, because the Japanese index Nikkei is at an all-time high level. Even if you look at the European index DAX, the German one at that, and that too is very, very close to its record high level. And if you look at the S&P as well as Nasdaq in the US, these indices are sitting at least 8 to 9 months high, because they are at the highest level that we have seen since August of 2022. Kunal, before we come to our own index, you track all of these global indices also very closely. What is your reading?
You've not seen the Nikkei chart, but if you see the Nikkei chart,
I have seen the Nikkei chart, all-time high, and the solid rally that we have seen.
The last 5 days, there are 5 gaps which are created in Nikkei, and those are big gaps which you're talking about on the Nikkei chart. So it's very,
what does it mean?
So this indicates that this is a powerful move. It's not just a move which is exhaustion. So there's a move which we say that it's an exhaustion move, it's the last leg of a rally. But this seems to be a starting move for the Nikkei index.
But Nikkei has done nothing for the last, a decade, I think. It was very, very, very range.
No, I think I remember, in 2008-9, Nikkei came back to its 30-year low at 8,800 something. And from there, it's been on a steady uptrend post that.
Interesting, but what about then our own index? Is it also seeing a powerful rally or something of sorts?
So I think we are tiring out some, but I think again it's a good consolidation that we're trying to digest. The last 1.5 uptrend of the indices, large cap stocks taking a bit of a back seat. So there's a bit of a churn which is happening within the large cap names. The only factor which I think could probably stall the uptrend for our markets as well as for many of the other emerging markets could be the rise in dollar index, because the correlation between the rise in dollar index with respect to the Indian market trends at least have not been very positive. We've seen the dollar index, for example, the recent one was a rise in dollar index from the December lows of 101, 102 levels, and that created a bit of a correction for our markets as well. So this time around, dollar index has bottomed out at closer to 101.5, and now we are at 103.5. So if it's just a very short-term kind of a rally, that's what you could probably trigger another round of uptrend. But if the dollar index rises up further, significantly higher, and the pace increases up higher, that could stall the rally for our market. So that's the only point of concern. But other than that, global market, the way many of these indices are breaking out, I think is an absolutely charming number to see.
Okay, that's the view coming in on our own markets. It's dying to get in a view on individual stocks as well. But let's get in your take first up, Naresh, as to what you make of the moves that we witnessed in trade yesterday and basis the kind of global handover. What are you working with for our markets today?
So the expectation is the same. We get into a range. 18,000 becomes a base going forward, and that's a critical price point. It's 17,800, 18,000. Till the time we are above that, the uptrend is still maintained. On the upper end, 18,400, 450 is the resistance on the Nifty. Bank Nifty is again not being able to cross that 44,000 mark. We are not seeing that leadership come in. We've not seen any of the top two, say, banks make a major move. Only ICICI Bank has been leading up, but HDFC Bank continues to struggle. So overall, getting into a range-bound move, we are seeing decent enough action on the mid-cap and the small-cap space. In the last 3 days, when the Nifty has corrected, the mid-cap and small-cap indices have not taken a hard knock. Generally, in a 300-pointer, 200-pointer down move from peak, we should see a little bit of a correction on the mid-cap and small-cap indices. It's not. So clearly, we are looking at it as a pause. And once we spend some time here, post that, we can see a fresh move. So for now, focus more on the stock-specific ideas. Let the markets consolidate and wait for the next trend.
Okay, wait for the next trend. But what are the trends that you're spotting at the stock level, Kunal?
So I'll suggest a couple of buy calls, mid-cap as well as large-cap. So mid-cap wise, IEX is a stock which I would suggest as a buy. V-shaped recovery for the stock in the last 5 days from being at a point of 163, correcting towards 155, and then rallying back towards 160 mark where it closed yesterday. So expecting this up move to continue for IEX, forming a bullish flag pattern on the early charts, targets of 170, stop loss 155. And ICICI Bank is the other stock which I would continue to bet upon. Again, large cap, strong private sector names, banking name in the last 2-3 days of market volatility. The stock has not corrected even by a matter of 2.5% from its previous swing highs. That indicates the strength for the stock as compared to the other peers. Buy with a target of 980, stop loss 920.
Okay, and Naresh, what about you? What are your top recommendations this Friday morning?
So going a little defensive with a long and a short. First is a buy on IndusInd Bank. The stock has clearly shown relative strength over the last 3-4 sessions. Now the stock is trying to show leadership out here in terms of a longer term chart as well. The stock has come back to almost 1240 levels. 1250 to 1270 levels has been the high for the last 1.5 to 2 years. As well as pre-COVID, the stock used to trade at 1250 to 1300. Sustaining about 1250 would be a longer term trend change, which would open up a much higher target price. For the near term, I would have a target price of 1400 and a stop loss at 1190. Second is a sell on DV's Labs with a view of 1 to 3 sessions. The stock has given a short term trend change, keeping a strict stop loss at 3200 and a target price of 3000 to 2900.
All right, there you have it. Those are some of your top recommendations to keep an eye out on in trade. Tell you what, we'll take a very short break right here on the show. Be right back. Welcome back. Still tuned into the market. Well, yesterday we were closely tracking Jubilant Food, and it was a big interview that we took as well. As the management spoke to ET Now's Nikunj Dalmia, Jubilant Foodworks Managing Director and CEO Sameer Khetrapal, and he spoke on a range of issues, starting from the demand trends, the outlook on QSR amid inflationary pressures, the role of tech, as well as what the outlook is for Jubilant Food. Let's listen in to what he had to say.
If I look at the same store sales for Jubilant Foodworks and for Pizza Hut, there seems to be a decline in the pizza demand and there seems to be an uptick in burger demand. what is your view on the pizza category growth per se? Because that is the big question which perhaps we need to understand and address.
Sure. No, I think I will answer your question again. Firstly, the overall QSR or organized QSR as a service is minuscule when it compared to eating out. So it's less than 2%, and the competition is not necessarily with Pizza Hut or some other pizza selling chain. It is also with a samosa and a vada pav and an idli and a sambar, right? Because that's where the large market is. Now, having said that, coming to pizza specifically, cheese has been a decadal high in terms of price. There was huge, we face unprecedented inflationary pressures on oil, on wheat, and therefore everybody took price hikes and passed it on to the consumer while also looking at internal efficiencies. So I see this category to continue to grow at anywhere from 13 to 15%, maybe higher, once some of the bases normalize. And it is more to do with the price hikes the industry has taken because of unprecedented decadal high prices that we saw. So it should get normalized very quickly, in my opinion, and pizza will continue to grow healthy double digits.
Well, let's get going and welcome on board Sachindra Nath, the Vice Chairman and Managing Director at UGRO Capital as well. The reason why we are speaking with the management is the fact that a marquee name has yet again checked into the counter. Mr. Ashish Kacholia has bought over 1% stake in the company. Mr. Nath, thank you so much for making time and speaking with us. Well, this entire MSME lending space has generated a lot of interest among several notable investors as well. You recently raised 340 crores via QIP as well. What do you think is driving the investor confidence, and what are the key potential that you see for the vertical that you address to?
Thank you. See, as I've been telling your channel the last time as well, that I believe that you are seeing a decade or even more, a longer period of explosion of credit for small businesses in India. It is happening on the back of two things. One, there is a level of data or digitization which has happened for MSME. And second, the net contribution of MSME to GDP is growing with every passing day. This is a segment of the market which contribute one of the largest employment into the country. It provides, livelihood to, lakh crores and crores of people. So once the post demon and once the GST happens and once, digitization of banking has happened, for lending institution to now underwrite credit by using data and looking at the current data and say yes to the credit is now possible. And obviously we started that journey 5 years back, and we are ahead of that, and that is driving the confidence of investors at large. That's my presumption.
Mr. Nath, but you have a very, very ambitious target, and please try and appreciate our incredulity at it, because your current AUM is what, 6,000 crores, and you are targeting a 20,000 crore AUM within a couple of years itself. What are the levers that you see for this massive expansion and massive growth that you're penciling in?
So I was giving this example to somebody else, that think of a guy trying to make a banquet hall and somebody is trying to make a convention center. So obviously when a convention center would come up, the capacity of that would be much larger than what would be a banquet hall. Please appreciate that this is a company which in 2018, when it has hardly any business, straight away raised 1,000 crore of capital from 4 large global private equity funds. It just so happened that after that, ILFS scope happened, DHFL happened, Yes Bank happened, and COVID happened. But in spite of that, we during the 20 and 22, we built massive capacity. This company has grown from uh, almost 200 people to 2,000 people, 9 location to 100 plus location. Our digital infrastructure has grown from 5 people to 250 plus people. So the infrastructure and the capacity itself is now delivering the volume. I don't think so. It is, and also remember this, that some of the market leader look at the data around Bajaj Finance. Bajaj Finance in 2008, if I remember correctly, was 7-8 thousand crore. Today it would 2,52,000 crore. So a 45% CAGR growth in credit business in India in the initial 5, 6, 7 years. This is the way the businesses grow. When you said we have an ambitious target, look at our March number. In the month of March, we disbursed 600 crores of loans, which means that if we just simply maintain that run rate, and that's our plan, this year we will be disbursing around 7,200 crore of loans. At an exit of 6,000 crore plus 7,200 crore, it is 13,200 crore. And if the runoffs are 3,000 odd crore, we should be near about 10,000 crore. But the capacity which we are building, the March 24, we would be again exiting at something around 800 to 900 or 1,000 plus crore, which means 24, 25, we will again disburse around 10,000 to 12,000 crore. Look, this target of 20,000 and 10,000 and so on and so forth, it is an aspiration which we set for our own teams and what we can achieve. And markets, I think our bigger goal is to serve 1% of MSME market in India. Now this 20,000 can be 18, can be 21, but it is a message that we want to build India's largest small business financing institution.
Okay, point taken. What about the outlook then, Mr. Nath, when it comes to your asset quality? What kind of outlook are you penciling in when it comes to your asset quality trends?
So, one of the very unique thing, not just for us, for anyone who will use this method, we look at customers' cash flow on an as-is basis. So once we pull the GST of a customer, when we pull the banking of a customer, and when we hit his bureau, and when our growth score runs, we know the three things of the lending: intent of the customer, eligibility, and ability to pay. Second, today, roughly around whatever customer walking into our door, only 30% of that gets loans. So our login to disbursal rate is only 30%. Which means that our systems are being able to filter out customers who have little less paying capacity. And if you look at all through our COVID and post-COVID trend, we are roughly around at 97-98% of collection efficiency. All our static pool data are showing good trend. Unless there is a COVID-related crisis, we think so that as we have guided to the market that our credit cost would range between 1.5% about, because we also construct our portfolio accordingly. We do MSME financing from secured to unsecured, from 11.5% to 18.5%, and all of that high degree of secured loans ensures that our credit cost remains under control.
Appreciate your time, and thank you for joining us. Well, Nasdaq has shot up, and we were discussing this, that while we're talking about banks in India and we're talking about IT not doing well, Nasdaq is at a 52-week high. S&P is at a 52-week high, and these are big markets which have made a roaring comeback in middle of the year, when we are talking about a possible volatility which could have because of debt ceiling. Sandeep Sabharwal, it's a bit of a surprise for me to see that Nasdaq, which is ultimately a representative of tech stroke lose money stroke high P multiple stocks, that has made a 52-week that is at a 52-week high.
Yeah, so there are various reasons for that. Some of the large US technology companies have reported strong numbers and guided for strong performance, like Microsoft, etc. Secondly, the valuations of the technology sector in the US, especially those comprising large parts of the Nasdaq, are highly correlated to interest rate movements. And as the bond yields peaked out and started falling, we saw the valuations move up. So, and plus, as we come closer to a recession and slowdown concerns peak out, that's the time some of the growth stocks will start performing, assuming that there'll be a growth revival going forward. I think these are the factors which are going on. And the dynamics for the Indian technology companies, unfortunately, are different, where it's more to do with the overall outsourcing story. So while many companies out there started to suffer early on, the Indian companies continue to do well and they are feeling the impact now. So I think there'll be a lagged impact on Indian technology companies.
Sandeep, we were discussing SBI versus ITC, that there was nothing wrong with the SBI numbers, it fell. There was nothing great about ITC numbers, but every brokerage who tracks ITC, they've upgraded their target. Do that comparison for us. Why did SBI fall? Does ITC deserve a re-rating?
So ITC re-rating has gone. See, the key thing you need to watch out there is, one, the valuations are still below most of the consumer companies. So now how much cigarette business valuation people want to give, that they have to decide. But there's no case for a big downside from current levels, and I don't see a big upside in the near term also. But the dividend yield itself is so high, like 15.5 rupees on a 400 rupees stock is almost 4%, which is higher than the saving bank rate of the large banks. So I think that supports the ITC stock. SBI, of course, the kind of huge increase in operational costs plus the concerns related to the new norms RBI is coming out with and its impact on PSU banks is impacting SBI and other PSU banks in the short run. Because what happens is that lesser write-offs, highest margins, high margin expansion, etc., will help you at a time when current times when operating expenses went up so much, it could shield that. But as growth slows down and as margins also peak out, high operating cost increases will lead to reduced profitability increases. So I think that's the concern which some of the market participants would have had.
Sandeep, let's just focus in then on what was announced by SEBI, the proposal of uniform total expense ratio for mutual funds. And we have Sunil Subramaniam as well as Radhika Gupta joining in to discuss that. To begin with you then, Radhika, I just wanted to understand what exactly your outlook is in terms of what this would mean now for the mutual fund industry as a whole. How are you looking at these proposed changes?
Hi, good morning. So, I think it's a vast set of changes, and these changes have been discussed, and one has known that some of this is, likely on the cards. I think the net is products are likely to get cheaper for the consumer, which is probably a good thing. There are some very interesting proposals, particularly around the introduction of performance fees, for instance. That could give, some interesting scope for innovation in the industry. I think the major change is the moving to category-wise rather than scheme-wise TER. And I think that will have very differential impact on different kind of players. So large, medium, small AMCs, I think will all see a very, very different kind of impact. Some will see, perhaps margins shrink. Some will see margins go up. So I think that is the most major one. But we'll have to look at the final contours when this comes out. There's still a lot to make sense of in the document, and it's still only a consultation paper.
Sunil, do you see a big impact on the profitability of AMCs because of this? That's something which everybody wants to know.
So I think that if you look at the listed space, they are mostly the larger AMCs. And as you're aware, Nikunj, this is a high operating leverage business, right? Fixed costs are very, very high. So to that extent that cost-conscious investors would naturally migrate to larger AMCs, I see that from an investor side effect, larger AMCs will get more volume of business. Now, on the commercial aspect of the reduction in the TER, how much they take the hit and how much they pass on to the distributors, again, larger distributors would push back and there would be an arrangement. But it's the smaller mutual fund distributors, right, who would take the biggest hit. So I think the impact on the listed players would be minimized to the extent that they will benefit from larger flows, I would say, because their costs will be much lower compared to a smaller AMC. Within the industry, I expect this move to help the larger players. So from a listed player perspective, I guess these are all larger players. So I think that the pass-on ability of the larger AMCs should be able to protect their margins falling. It's not as if there will be zero impact. There will be some impact, but I think that they will be able to cushion a large part by passing on to the mass distribution. So I think that this move, like I said, it should help the larger AMCs get a larger share of investor-oriented direct business.
Sunil, the debt mutual fund is where the TR, according to what SEBI is proposing, should come below 2%. But can I say that it is already below 2% for big AMCs? So in totality, the impact is not going to be large.
You're absolutely right, Nikunj. Not only that, if you look at the debt side, right, institutions still play a big part, and institutions have driven down expense ratios on debt mutual funds quite some time back. So very few debt schemes were operating at the high level. In fact, if you take another aspect to it, Nikunj, there's a direct impact on investor returns because you are talking about, wherever you have indicative yields, you know at what rate you're lending to the corporate, you know what the margin is going to be and so institutional investors are very acutely aware of their returns. So already liquid schemes are at about 10 basis points. Short-term duration schemes are at about 25 to 30 basis points. And medium duration funds, right, I would say whichever the larger players are there, they are all operating around the 1%. So the 1.2 SEBI, the debt mutual fund impact is actually very limited. A few small schemes may be charging very high from the smaller AMCs. But overall for the industry, while on the headline, it looks like a huge drop for debt, the actual TER impact on debt will be marginal because anyway, the cost-savvy institutional investors were driving the TRs down already. So I don't expect that to have significant impact.
Radhika, just before we let you go, final thought as to what portion of this would be passed on to the RTA, the distributors, brokers, etc., and what part is something that the mutual funds and the AMC industry will have to bear?
I think it's going to be very dependent on individual AMCs. I think in fixed income, I disagree with Sunil. For instance, a credit risk fund, if it goes from 1.5 to 0.9 in a large AMC, which is the lowest slab that is proposed, then perhaps there will be some pass down and some will have to be absorbed by the AMC. I don't think in this scenario, in a large AMC case, you may be able to pass down 100% of it. I think that will be hard to do, in my opinion. Some will be passed down, but I think the hit will be collectively taken. Historically, I don't think the pass down has happened to RTA. So I'm not sure that that is likely to happen, although there's no reason that pressure won't be applied there.
Well, Radhika, Sunil, thank you both for joining us and sharing your thoughts. Let's look at AMC stocks, how they've done in the last 1 year. SIPs are going higher. Indians are saving more in financial assets, but all the AMC stocks, HDFC AMC was at 4,000. Now it's at 1,810. Birla AMC is nowhere close to its issue price. UTI AMC, which has been on the block where the Birlas have bid and the Tatas have bid, and finally government has not taken any kind of a decision yet. But that's Aditya Birla Sun Life, and that's UTI AMC for you. All of them are down 24-25%. Sandeep, the cat is out of the bag. We know which way things for the AMC industry will move now. SEBI, in a sense, has pretty much given us an indication of how the profitability in the TR would move. Stocks are down 25 to 40%. Is it a good time to buy into them? Because you're now buying them at the peak of pessimism and the peak of bad news.
So I think the main issue AMC stocks companies have been facing is the continued reduction in overall expense ratios allowed, as well as degree of non-performance from large established players which are listed and which has shifted market share away from them to some of the other smaller players or to alternative investments and even direct investment into equity. So I think that's where the big concern around AMCs is. And a lot of people, because of this underperformance, are moving to index funds, whereas it is the amount you can earn out of the management fees is very, very low. So the only thing is that as if SEBI comes out with some norms on performance-related fees for performance, that could help drive up overall performance of AMCs as they focus on performance and then also shareholder return. So, but we need to see the controls of that.
Kunal, just let's discuss what's been going on with those real estate stocks because, after that one-day pop, we saw the terrific run-up. Third straight day on the chart that these stocks are cracking.
But the likes of DLF is not cracking as such. I think that stock is down 10-15 rupees only. Oberoi Realty is. Yeah, Oberoi Realty is cracked. So the components within the sector holds the significance that whether this is just a short-lived up move or whether this move, even if it's a corrective move, that post correction there is a higher probability as well as chance that the index can make a strong comeback. And the larger stocks which have been strong performers, they are still holding their fort. The likes of Sobha, Kolte Patil, many of these other stocks which were high flyers in the last 1.5 odd month. Which has been sporadic, volumes for themselves. These stocks are correcting sharply. The likes of DLF apparently is not correcting as sharply as compared to the other peers. So Anantraj Industries, if I'm not wrong, yesterday made a high of 150 plus mark itself. On a day where the real estate index was actually going to a correction. So it's not all components within the real estate stocks which are going through a correction. I think that's a good sign that this could just be a very stock specific correction within the entire real estate pack. Post maybe a couple of more weeks of consolidation, I would believe that these stocks should make a strong up move back again. Would be extremely bullish on the likes of DLF, Anantraj from a short to medium term.
Okay, so that's about some of the real estate stocks, but there are big changes which have been announced by Chris Wood in his greed and fear portfolio as well, because he's increased the India weightage by 1%, and it's reduced Thailand by 1%. But internally speaking, they have introduced Thermax as well as Axis Bank into their long-only portfolio with a weightage of 5 as well as 6% respectively. They've removed investments in ICICI Lombard General Insurance as well as Maruti Suzuki India. They've reduced the weightage in HDFC Life by 1% when it comes to the long-only portfolio. And if you look at the Asia ex-Japan long-only portfolio, they have added the weightage on L&T by 1 percentage point. So, Sandeep, there seems to be a clear tilt happening even when it comes to the FII flows with respect to the capital goods space. Case in point here, Thermax being introduced with a 5% weightage, increase in L&T weightage by 1% as well. Which are the stocks that stand out to you in this particular segment, given the fact all of these stocks have run up considerably?
Most of the companies are doing well, but I think your second comment is more important, that the stocks have run up a lot. So where the valuations are still reasonable is something people need to see. So most of the larger companies, be it starting from ABB, Siemens to the next leg, Thermax, Elecon Engineering, etc., to coming down to LA, and the largest player, which is more infra construction per capital goods, L&T, all are doing well. It's a question of valuations now because stocks have run up so much that we need to wait for either consolidation or some correction to add on to them. For whoever is owning them, I think there's no reason to sell.
Couple of numbers here, and one company which has disappointed again and again is actually United Spirits. Margins are down from 17% to 13%. PAT is down from, PAT is flat, EBITDA is down, but margins are also down. Sandeep, this company amazes me. There's no linearity. I mean, we can say that Indians are consuming more alcohol. We can talk about the fact that that's the way how the migration of a society has happened. That is how the wealth effect would kick in. But the volatility in United Spirits numbers has been extreme.
Yeah, it's been very all around the place. But I think there are two things. One, the results are much better actually than expectations, because expectations were very low given the management guidance, etc., on costs, etc., which came out at the end of last quarter. So operating profits actually 337 crores versus around, I think, 290 odd crores, which the analysts are expecting. So reported result vis-a-vis expectations are better. Now, that said, the strategy of the management, where they removed most of their high volume brands, low cost brands, to just focus on the premium side, was a wrong one in my view, which happened when the new CEO took over. And that it's because in a country like India, you can't move away from value. And those brands are actually big brands for them. So I think that's a bigger issue of strategy, which shareholders of United States need to be more concerned on. And the reported numbers are actually not bad.
Okay, in the meantime, Naresh, your take as far as Gland Pharma is concerned, that stock has been on a one-way downturn from the levels of 4,000 plus. It's down to 1,300. And today the numbers are again very, very weak, sharp decline in profitability. The margins have eroded. What should one do? Book their losses, or there's some case for bottom fishing here?
So the case for a lot of these pharma names is we've just seen one-day recoveries and again it fizzles out. So Gland Pharma on a single day went up 15-20%, back from 1250 to 1450, and then just faded off over the next 3 weeks. So this is just still an indication that the bottom is not in place. So does not make sense to do any bottom fishing. It's just spent 3 months around that 1200 mark. So for now, it needs more time and more price consolidation before it bottoms out. So too early to call a bottom, so no bottom fishing here. And even the best of the pharma names which saw a recovery have not been able to hold on. So Sun Pharma or Dr. Reddy have also fizzled out. So overall, the space, the pharma space still remains tricky. And names which have fallen 50-60% are still very tricky. So Gland Pharma would still be an avoid.
Tata Elxsi, and they've also come out with numbers. PAT marginally up, revenue marginally up, margins marginally down. Why am I bringing up Tata Elxsi? It was at 10,000. P multiple just went out of whack. It's got a low equity base. And it's got a low equity base. It's a Tata Group company. Tata Group stocks went crazy in 2021, 2022. So it had everything going for itself. The business was growing in the technology space, a Tata Group company, and low float, and the stock just went berserk. P multiple went to some 70-80 times. It's down from 10,000 to about 7,000. But I think based on these numbers, the stock we just face some more music. But the company which I want to discuss with Sandeep, and maybe here's something which we'll discuss, is it a good time to buy, is Bata. Profits are marginally up. EBITDA is marginally lower. Now, nobody was expecting good numbers from Bata, Sandeep, considering that raw material pressures were at its peak. If the stock falls today closer to 1,400, 1,450, would you be buying it?
Because again, our results are better than expectations, both in terms of sales, where they are up, I think 3-4% more than expectation, and profits, which are around operating profits are nearly 10-12% above expectation, and reported profits are around 15% above expectation. So I think the impact which many of the footwear companies and also Bata took because of the excise duty hike and general slowdown in consumer demand, that seems to be reversing. And raw material price pressure, I think, peaked out, and from here on, we could actually see further improvement in operating profits. So I don't expect actually the stock to fall. And this is a stock which we have been actually buying as a disclosure over the last 2-3 months. And I would remain positively inclined.
Naresh, some breakout shares. Nazara Tech, that was a mover in yesterday's trading session on the upside. And you also had something like an Indigo Paints that was active. What's your view? What's the chart reading like?
So Nazara Tech is interesting for the fact that the stock has gone through a 1 year of consolidation. A little too early to call a bottom, but at least the consolidation is in place. So if you look at the price, the stock made a bottom around 450 to 500 back in June of last year, as well as in May of last year. And we are in May of this year, we've made a bottom around that 450, 500 mark. 630, 640 is a major resistance. Once that crosses, that would be the first indication a bottom is in place. But seems like signs of bottoming out here, 1 year of consolidation. So the stock would be on radar once it crosses 630 levels. For now, it is a little too early. Indigo Paints, on the other hand, has seen a sharpish move over the last 2 months, up from sub 1,000 levels to 1,400. Still, the longer term trend is weak. The risk rewards are not great because it went to a one-way fall even in the last 6 months, went from 1,700 down to 1,000 rupees. So out here, I'll be a little careful, but would be looking out for Nazara Tech, and we are seeing this happen in a lot of new age tech companies which went down 50%. have gone through a 1 year consolidation. Nazara Tech also fits into it. So waiting for a close above 630 to confirm a trend change.
Okay, so that's the take coming in on Nazara Tech and a couple of other big buzzes as well. But shifting focus to the auto sector, recently off-road SUV battle has intensified as Mahindra Thar gets Maruti's Jimny as the new competitor. But now the question arises, who's better than whom and how does these two models stack versus each other? Shrishti is joining us with a better perspective on that.
So the battle in the off-road SUV seemed to be intensifying because till date this niche category had the dominance of Mahindra Thar, but now make way for Maruti Suzuki Jimny, which is launching this particular weekend. Onto your screens you will see the specs for Mahindra Thar as well as Jimny, but wherein Jimny can take the lead, especially when it comes to the price differential, because Mahindra Thar comes in a price range between 10.5 to 16 lakhs of per vehicle, wherein Jimny is expected to have a price range between 10 to 12.5 lakhs, so way cheaper. Other than that, if we look at some of the differential that is between Thar as well as Jimny, so Thar, if we talk about, then this is definitely wider and taller than Jimny. Other than that, it has a more ground clearance, which is much required when we talk about the off-roading experience, and 60 to 70% of the Thar is sold to the diesel variant, wherein Maruti is absolutely not there right now. When it comes to the Jimny, not just is the pricing that will take the leap ahead, they are offering an all-wheel drive versus a two-wheel drive of Mahindra Thar, which is seen to be at the similar price. Other than that, this comes in a 5-door variant because till date a lot of these Thar buyers are waiting for that. And do remember that Maruti has already tasted that off-road SUV success in the past with the popular Gypsy. You can't forget that product. So that is another thing. But let's talk about the booking numbers and how it is expected to pan out, because what we understand is that Maruti Suzuki already had 27,000 of bookings for Jimny, wherein Thar, they have a monthly run rate of around 5,000 of units. Analysts expect that Jimny can take some bit of a pie, and the monthly run rate is expected at 2,500 of units is what they are understanding. So this particular space is definitely getting interesting.
Okay, the battle of the SUVs. Thanks very much, Shrishti, for putting all of those details into perspective. Let's shift gears then and move away from auto, focusing on fertilizers. In particular, Deepak Fertilizers is in the spotlight on the back of what's been a fairly good set of numbers. Shailesh Mehta is the Chairman Managing Director who now joins us on the show to discuss the quarterly performance. And let's begin, Mr. Mehta, by breaking down the numbers across your segments and what is the outlook then for FY24?
Sure. So just to share the good news in terms of the last 12 months, because we just finished our board meeting evaluating that. And there I must share the good news that, our revenues have jumped by around 47%. And we have crossed the landmark of 11,000. So it's around 11,300 odd crores. And so also in terms of profits for the whole of last year, they have jumped by around 77%. There again, we have crossed the landmark of 1,000 crores. And, we've touched almost 1,220 crores odd. So enthused by the results of the last year, the board have recommended the highest ever dividend, which is 100%. So coming to Q4 and then going forward, having said that, one of the biggest takeaways that we have seen in the last year is that despite raw material price hikes almost 60 to 80%, and corresponding finished good prices that also went up substantially last year, we had no demand destruction. And that is, very strongly validating these fundamental aspects that all the three businesses, fertilizers, mining chemicals, and industrial chemicals, all the three businesses are beautifully aligned with the India growth story. And that is something which we see as a fundamental strength.
Now, specifically, the ammonia plant expansion was supposed to get commissioned in Q1 FY24. What is the status of that?
So it is as what we had shared earlier, that it is completely on track, and it's in the last leg of commissioning. So definitely within this Q1, we should be commissioning the project. And that is going to have a massive, I would say, fundamental risk mitigation for the rest of the businesses besides the margins, because the vagaries of the ammonia prices, that we saw last year is something that is going to be now insulated, for the group, thanks to the large ammonia project. And that project is going to be supplying almost 100% of our total requirements that are there. So it's going to be something that will bring in a lot of stability. So now we will be from end to end, ammonia to all the downstream. The value chain will be captured in the group itself.
Mr. Mehta, could you detail out to us what would be the impact perhaps of delayed monsoon that the IMD and SkyMet have been talking about? And if at all that El Nino impact does take place, what would it do to your fertilizer segment?
So basically what we are seeing is there are mixed feedbacks. The IMD says that, it's going to be 96% of the long-term average, whereas SkyMet is saying 94. We are looking at that closely. But somewhere they are saying that it's probably going to hit in a little later part of the season. So for Maharashtra, where rains are expected from mid-June, we should catch the early season. And of course, we are recasting our, complete sales and distribution planning to have more of the irrigated areas as our market in the coming Kharif. So we are looking forward to, managing the scenario in that fashion.
Coming to the demerger, where do you stand in terms of the completion of the demerger, and what is the expected listing date for the subsidiaries?
So basically what we are seeing is now we are just, in the midst of the NCLT processes, and that part of it, the typical time that it takes, we are expecting maybe June, July, when we expect to resolve all those aspects. In terms of listing and all, it is going to be, of course, linked to the growth plans. It's going to be linked to somewhere, interests of strategic investors that are emerging. So we will, merge that with the strategy of growth for each of those segments.
Rupee is its lowest level since 20th of March. Okay. What is the peak demand level you're looking at? Can you also give us, can you also bifurcate the debt between the segments?
So broadly, peak debt could be something around 4,000 odd crores, but, we will have a healthy 2.5x net debt to EBITDA. So that will be a comfortable state all through. And we are having a run rate of around 400, 450 crores of EBITDA per quarter. So, we are in a very good shape. Basically, the two major investments that we have taken up, one is the ammonia project that we talked of, which is actually the key raw material for all the three segments, the fertilizer business, mining chemicals, and industrial chemicals. So that's one investment that we have taken up. And the other is technical ammonium nitrate, which is, purely focused on the TAN business, that is a mining sector that is there. So those are the sectors that we are seeing a lot of promise. And of course, ammonia as a raw material, coming into the group fold will be a huge risk mitigator for all the three businesses as we go forward.
Okay, Mr. Mehta, we'll let you go on that note. Thank you so much for joining us. The pre-open rates are settling, so let's take a look at that as well. It looks like we are going to trend higher. The Nifty is expected to start around that 18,200 mark and a gain of around 125 points for the Sensex. In terms of specific stocks, it's Indigo, which is showing quite a bit of move this morning. So that inline set of numbers plus the positive commentary is something which is expected to have a good impact on that stock. Strides Pharma, which has actually received an EIR, and there's been one notch upgrade from OAI status to VAI status, one of the facilities, so that's reacting positively. On the other hand, Gland Pharma is down as much as 9% in the pre-open rate, so we are tracking that as well. So a lot of result reactions really to track, but what are the top mid-cap strategies coming in from technical experts? Let's figure that out with Naresh and Kunal. Naresh, what is your top mid-cap strategy?
So continue like Gujarat Gas, which is starting to build up a base around 460, 470 levels. From there, the stock is setting up for a breakout, testing that 500 mark. Above 500 would be a breakout. So a risk-reward trade here, a stop loss at 470 and a target price of 550.
What about you, Kunal? What's the top mid-cap bet?
So it's something which I recommended yesterday, Poonawalla FinCorp, for a target of 350. So the targets remain the same on the upside. Stock confirming a breakout on the short term as well as on the medium term charts, trailing the stop loss higher to 327 for traders who are looking at a fresh buy.
Okay, so that was the top mid-cap strategy, but just wanted to highlight one of the small-cap stock as well, Sirma SGS Nikunj. Again, a very solid show coming in from one of this manufacturing name. The revenue was up 82%, the profitability has gone up to 42 crores versus 17 crore, and this entire space is all good for a re-rating, it seems.
No, the re-rating has already happened. The recognition has already happened. I think now the revenues are backing the belief. See, some of these sectors have potential to become very large. Are these the sunrise industries which can grow with limited capital need? The answer to that is actually yes. You know, these are not long gestation infra projects where you will keep on raising a lot of capital. These are companies which essentially have margins which are in double digit. These are companies where you would argue back and say that the size of opportunity is very large, largely because of the talent pool which is getting created in India and China one policy. And see, there are these PLI schemes which in a sense are giving government wants the manufacturing to, come in there. So what does well, Anisha, from a stock market standpoint? First, you have to understand that what is relevant today, will it become important tomorrow? What is small today, can it become large in next coming years? Can it migrate its journey by taking care of investor and shareholders, which is return on capital, return on equity without too much of equity dilution? Can it continue to keep on paying dividend? And is there a general tailwind in the environment? Now, the tailwind in the manufacturing sector is very evident. Government has come out with PLI schemes. They've been brutal in putting anti-dumping duties in Indian sectors, which in a sense were not competitive enough, largely because of the Chinese and other countries dumping the same products into India. See, there is definitely a recognition now that India is just beyond a services sector. I mean, if an Apple phone can be made in India, then a lot of other sectors could move in. And fourth, the nature of the manufacturing sector is such that China is vacating a lot of spectrum. The same thing I think happened in the chemical space between 2019 and 2021. Chemical stocks went to P multiples of 50, 60 times. I see a similar phenomenon. Mark my words. Let's write down the date. 19th Mark. Mark my words. A similar phenomenon I think will be at play in the manufacturing sector.
Our promo is getting ready.
No, I hope I get it right, but...
Well, we have been getting it right when it comes to the markets because we have been consistently saying that FIs are likely to come back. That's been happening for 16 days on a trot, and the buying on dip strategy has been working out for now. But what are the index calls coming in this morning? Let's take a look at that as well. As far as the Nifty call is concerned, you have a hold rating coming in from Kunal Bothra as well as Naresh Mirani, while Santosh believes that buying on dips is likely to continue. So that's the consensus rating coming in on Nifty. That's a hold. Similar story playing out for Nifty Bank as well. Kunal and Naresh believe that it's best to hold on to your horses and just continue to hold positions as far as Bank Nifty goes. But Santosh is quite bullish. He's suggesting further buy on dips.
All right, let's revisit the two big earnings candidates yesterday, SBI versus ITC, and here are Nikunj's take on these, on both of these stocks.
Bounce back, and I'll tell you why it will bounce back is because what happens in the short term is a function of F&O, technicals, the weekly expiry, positioning. There is a whisper number, there is a HOS number, there is an estimate number, and then there is an actual number. So there are too many numbers which keep on floating around. So depending on what the positioning is, what that day's compulsion on the Nifty or the Bank Nifty is, the stock will move. I don't see anything wrong with the numbers. I mean, I've said that who says elephants cannot dance? Here's an elephant which has started dancing. That's State Bank of India for you. How do you look at bank? You look at bank in terms of, at this current juncture, nobody is bothered about NPAs because the NPAs are not there. We are beginning of a credit cycle, or when we are in a strong credit cycle. So they are talking about a growth which is still in double digit on that kind of a large base. B, expected credit loss, that's the ECL loss, and the dilution risk is going to be very low, which was a concern which came out after the Canara Bank numbers. I think State Bank of India, in a sense, has doused that. Net slippages could remain negative, but the 9 months leading to it were very low, which means there is no problem in terms of net slippage. ROA, which is where Mr. Khara, I think, has done an incredible job of turning things around. ROA for State Bank of India historically was always under 1. He's taken it above 1 and he's managed to keep it above 1. And he's giving, or in State Bank of India is talking about ROA staying above 1. So I think these numbers are strong, and these numbers in a sense can really have an impact on the stock. Now the stock also, just think about it. In last December versus now, that's about 6 months. My producer will file 6 months graph for State Bank of India. In last 6 months, State Bank of India as a stock has done nothing. It's down 4%. And the Bank Nifty has gone the other way. Does it deserve to trade at 574 in this kind of a market? No. So what happens in the short term is a function of a lot of other factors. I think State Bank of India stock should bounce back. ITC is expensive,
Yeah.
The cigarette volume growth, impressive. FMCG business, impressive. But the P multiple, ITC is not at 200. ITC is at 400. The stock is up 25% this year. It's up more than 100% in last how much time, sir? ITC 100% up in last 1.5
Last March
years?
it was 215 to 20. So
It's doubled since then.
it's doubled.
Almost in 12
Almost
months.
1
it's
year
doubled.
and 2 months.
Yeah, so just imagine for a stock which nobody liked, it's up 100%.
Yeah.
So whatever happens to the numbers, with companies like ITC, you're not riding a cycle. With a bank like, with a cyclical business like banks, you're actually riding a cycle.
Correct.
ITC had gone through a volume uptick. It got battered down because of this entire ESG stepmotherly treatment it got. So the P re-rating has changed. Cigarette volumes have stabilized. FMCG business is growing. But there is nothing in next 2 quarters which will give you a huge trigger that will continue to keep on re-rating the stock. And under-owned stock has become purely, ITC is now getting the spot and price it deserves. But State Bank of India will have a tailwind which is called cyclicality in credit growth and low NPAs, which will keep on taking it higher. So if I have to choose between SBI and ITC in the short term, I would say it will be SBI. Okay, Apple and Samsung have shown interest to expand in India. Okay, we know that. Apple has opened a store here and they moved into manufacturing, and Samsung has already set up manufacturing here. Everyone is now realizing that India is the large market in terms of consumer, which is where you want to be. But back to markets now, 30 seconds to go. It's been a good week in my book. You had another 100 points today. You will be closing almost at the upper end of the range. 18,300, 18,400. Kunal and Nuresh are insisting that that's the level you need to cross before they get convinced that a near-term breakout has happened. Nasdaq is up, is at a 52-week high. S&P is at a 52-week high. So folks, there is a global tailwind also which we cannot underestimate. The trick is, or the tricky part now is that now that global markets have made a comeback, will India outperformance get challenged and will flows migrate back into other developed markets? That is something I don't have an easy answer for. But all I'm saying is that things right now are looking good, not obese for Indian markets. 42 points higher for the Nifty. The market breadth, grand open, sir. 1:5. I like to see such market breadth when the market breadth is almost near perfect. Is State Bank of India bouncing back? Now that's for me is more like a mystery that there was nothing wrong with the numbers. It is. Should ITC also bounce back? Well, brokerages are saying yes. So it will see a rub-off effect. But in terms of strength, no, it is not. So what we were discussing, Anisha Avan, in the morning, that the chances of State Bank of India bouncing back versus ITC, I think State Bank of India will bounce back. State Bank of India comes back, the Bank Nifty makes a comeback. The Bank Nifty makes a comeback, Nifty will have an extra fillip. So it's all tied up very nicely, like a string with pearls in it. SBI moves, Bank Nifty moves, markets move higher, a breakout could happen. I'm making it sound simple, but I think SBI could be the pivot stock for the day.
SBI might be the pivot stock, and for now it's definitely showing signs of that, 1.3% higher. But within the broader markets, a lot of result reactions. Let's pull up Gland Pharma. That's seeing a dropping of almost 12%. The stock has collapsed quite a bit already, but still at around 1200 levels for that particular counter. On the gaining side, however, there's GR Infrastructure up 7%. Ramco Cements is reacting to its numbers. Let's also pull up Bata India as well as Indigo. They were largely in line to a better than expected numbers. Let's see what the result reaction is on that one. And even Indigo, for that matter, that stock was also expected to show a positive stance. Let's see whether that has worked out. Greed and Fear has managed to add Thermax into their portfolio, so there should be a positive reaction to that. Nazara Tech is something that we are watching out for. So a lot of result reactions really to deal with. But you also have Sirma SGS. That's something that we should pull up because that stock managed to report a very, very strong set of numbers. Is there an appropriate reaction coming in on the stock price as well? Just 2% higher. Maybe the street was factoring in a lot already. United Spirits is one stock, and then the AMC stocks, of course. So HDFC AMC is something that we should pull up. Aditya Birla AMC is something that we should pull up. Yes, these stocks are reacting negatively given the fact that SEBI is coming out with a slew of changes that might impact their profitability. Concor and other result reactions. You also have Minda as well as Thomas Cook, which is something that we are seeing in terms of result reactions. PI Industries as well as Tata Elxsi. These are some of the counters that you need to have on your radar. Thomas Cook is reacting negatively. PI is higher by around 1.25%. And then Tata Elxsi, as we were anticipating, it's seeing a bit of a downtick. 3% cut. Remember, the earnings were tepid, and the fact that the stock still trades at very expensive valuation is something which is not working out well for the company. But for the Nifty Avan, it's a decent opening, 18,150. We're not seeing that 18,200 level yet, but not too bad, at least an opening in the green.
I wonder if Kunal agrees with that. What's your outlook, Kunal? The fact that we're around the 18,150 mark, would you have expected a further scale up? And of course, what's the first trade you're punching in?
No, I expect a consolidation, and I think it's a good sign that the markets are trying to digest, because there is so much happening across the globe in terms of events, many of the indices breaking out. The only concern with the index is dollar index still at 103.5 levels. That's the only concern with respect to the correlation. But net, I would still believe that the indices consolidate over here is a good sign. The stock which I would look to trade in the open would be on IAX. Very good recovery for the stock in the last 2 or 3 days from 153 levels to 160 where it tested yesterday. So I think at 159.60 levels looks attractive for a contra buy.